Good day to everyone. I'm Nicolas Bornozis of Capital Link, and I would like to welcome you to Capital Link's Trending News podcast series. Today, we have the privilege to have with us Dr. Loukas Barmparis, the president of Safe Bulkers, who is going to discuss with us the company's developments, strategy, and the dry bulk sector outlook. As a disclosure, I would like to mention that our podcasts are simply for informational and educational purposes, do not constitute investment advice or advice of any kind. And as an additional disclosure, Capital Link has the privilege to work with Safe Bulkers on investor relations. Safe Bulkers is a leading international provider of marine dry bulk transportation services operating globally and with a customer base that includes some of the world's largest users of marine dry bulk transportation services. The company's fleet consists of 46 vessels in the water with an average age of 9.8 years. This includes, Safe Bulkers focuses on larger vessels, and this includes 8 Capesize, 8 Panamax, 13 Kamsarmax, and 17 Post-Panamax vessels. Additionally, Safe Bulkers has an order book of 7 Kamsarmax Phase 3 vessels scheduled for delivery between 2025 and 2027. The company's common shares are listed and trade on the New York Stock Exchange under the ticker symbol SB. And additionally, Safe Bulkers has also on the New York Stock Exchange 2 series of preferred stock, Series C and D. And with that, I will welcome Loukas and ask the first question on the company's performance during the third quarter of 2024. Loukas, net income rose during the third quarter to 25.1 million compared to 15 million last year. Actually, for the 9 months, net income was 78 million compared to 49.7 million for last year. So what specific strategies or market conditions contributed to this increase?
Thank you, Nicolas, and also thank you for accepting me in this interview. The first 9 months of this year were quite comfortable. We had good markets. We had experienced good markets. What I could say right now is that as we approach the year end, the market has weakened. So we have a lower charter hires and lower charter hire environment. There are several mechanisms that contribute to the good performance. First of all, the performance of the company is related directly with the performance of the charter market, but also from time to time we take advantage of certain market conditions in order to book charter hires for longer periods. So, for example, one of the things that we have right now is that all our 8 Capes are chartered with an average of 24.5 thousand per day, while the market is, let's say, at 21.6 thousand per day. So this contributes not only to visibility, but also additional revenue. The second point is that we have sold older vessels. We have taken delivery of several Newbuilds. The Newbuilds are by 30% more efficient. They're so-called Phase 3 vessels, and the higher efficiency and the lower consumption of the vessels, of such vessels, is reflected in the charter hire. So when, let's say, the index for a Kamsarmax is about 9,600, which is what it is today, if we go out in the market, we can always charter a vessel which is Phase 3 at a premium, usually up to 30% premium, which represents additional profits. And the second, as you all are aware, and you have said in our press release within our last presentation, we have almost concluded the environmental upgrade of our fleet, which basically roughly contributes to a 10% reduction of fuel consumption, 10% increase in energy efficiency, and 10% reduction in CO2. So also this represents another premium in our charter hires when we go out in the market and charter a vessel.
Thank you, Lucas. Now I'll go to the leverage, to debt. Consolidated leverage remains at 32%, a level that you have described as comfortable. Are there any scenarios under which you might adjust this target lower? And how do you prioritize debt repayment versus growth initiatives?
What we have achieved until now is this 32% leverage. We believe that this is comfortable, and we feel that comfortable is whatever is between 30 and 40%. So you may see this going, I mean, our leverage going, let's say, as low as 30 or maybe 35, 36, depending on the situation. As new build vessels are coming in our company, are being delivered to us, you may observe, I mean, maybe a slight improvement of this figure. Also, as we repay the debt as we go ahead, there might be a slight improvement. At the same time, we may take from time to time small amounts of debt, but basically we use our capital allocation, a large part of free cash flows to invest in and take delivery of the vessels in order to maintain this leverage at the order where we stand today.
Thank you. Lucas, I'll go back to your fleet strategy. You already mentioned about the advantage that you have with your eco vessels and so on. Your fleet today is 46 vessels, 11 eco vessels, 11 phase 3 vessels, and all other vessels have gone through environmental upgrades, with the last one scheduled for upgrade in the last quarter of this year. So you have made repeated reference in your announcements to the green fleet advantage for safe bulkers. Can you elaborate on this? What is this green fleet advantage, and how does it position safe bulkers competitively, especially given the stricter environmental regulations?
Okay, first of all, let's see the immediate benefit. I mean, you have a phase 3 vessel. The phase 3 vessel burns about 30% lower fuel consumption compared to a traditional vessel. This results to an upgrade of charter hire by up to 30%, because you can trade that with a charterer and say, look, I have a reduced fuel consumption, so I need the benefit to be reflected in my charter hires. So this is quite often the case, and also this case is represented because, as we all know, when we have an index, let's say the BPI or the BCI, whatever the index is, vessels are traded at premium if they have better efficiency, or below this level when they are more heavy consuming. So this is the direct benefit. Of course, as we move along, vessels that are coming right now in Europe, they already pay the EU ETS, the European Union trading scheme. So you pay this taxation. From 1st of January 2025, the vessels need to pay also an additional penalty, which is the fuel EU, because they burn fossil fuels. And as we move along, I mean, towards 2027, 2028, there are other regulations that may kick on, like fuel, carbon levy, or global fuel standard, which will be decisions taken by IMO in the next few months, or probably within 2025. So this is another saving compared to what we have. The other point is that we have upgraded almost all our fleet, and this upgrade reflects to the fuel consumption by about, let's say, 10%. So in the existing fleet, 10%; in the new build vessels, 30%. When we sell or when we buy a new build vessel and we sell an older vessel, 30%. So all these are contributing to our cash flows and to our operations. So I think these are the mechanisms that we use to that they are existing in the market. These are the reasons why we have made these investments, and right now these investments have started paying off.
So, Loukas, if I want to repeat what you said, this means that you enjoy benefits in terms of lower fuel consumption and higher charter hire because of the environmental upgrades of your fleet.
Yeah.
So, going to the next question, given the current market conditions and your market outlook, what is your fleet deployment strategy, spot versus charter cover?
Look, presently, because the market is low, we basically charter at spot. So if the market is low, we charter. We used to charter vessels in the spot market because we don't want to book for a longer period at a lower rate. Now, when the market is higher, and this has happened during the past this year, we may do period time charters, and sometimes we have converted some charters which were, let's say, were close to their ending, expanding their charter period for a couple of years, and this also increases our benefits. This has happened in a Cape, for example. I would say one example, if you just look in our press release, the Cape Lake Despina was expanded for 4 years at 25.9 thousand. So instead of completing the charter hire with the past duration. So all these are demonstrate an active management of chartering. So all our team here, our CEO is involved directly in the charter hiring, and that's why we try to optimize the benefit for our shareholders.
But you mentioned that your Capes are under period employment.
Yes, but sometimes, when a period time charter goes towards the last part of the period, if the market is good, you may propose to someone, okay, look, do you want to expand it at this rate? And we had these opportunities this year.
So now going back to what you mentioned before about fuel EU and environmental regulations, we have the EU ETS. Now, as of January of next year, we have fuel EU. What do you think what will be the likely impact on the market of this additional regulation?
Look, the impact is an additional penalty that the vessels that come to Europe or leave Europe have to pay. This penalty is related to the reduction of the carbon content of the fuel. So basically, the existing fuels, the fossil fuels, have carbon content, let's say, of about 92. From 1st of January 2025, the expectation is actually the regulation states about 89 grams per megajoule, the unit of energy. So you need to pay a penalty for, let's say, for this 3 grams of CO2 that you emit more compared to the provisions of the regulation. So this penalty, I would say, is calculated right now. I think next year will be about $30 per ton, maybe, but after 2030, it could rise substantially. It could go to 100, 150. So this is one mechanism that makes more expensive the consumption of fossil fuels when they visit Europe. Of course, we need to differentiate because this regulation applies only to voyages towards and from Europe and to not apply in global trade.
Loukas, let me understand, for the fuel EU, I had the impression that you have to use fuel that has more green fuel. If you don't use it, that's where the penalty comes in.
Yes, correct, because the fuel EU applies to your fleet globally. So it's not only it does not relate to the performance of one ship, it relates to the performance of all ships. So if you manage in certain ships to use green fuels with lower carbon intensity, and the average goes to 89, because the important is from 92 average, you need to go to 89. So if this goes to 89, then you don't pay any penalty. But if, for example, you don't use any biofuel or any alternative fuel, and you stay with what it is today, the fossil fuel, which is at 92, then you need to pay this penalty. And again, I need to repeat that this penalty applies only to European Union voyages and not globally.
The lower carbon content fuel that would be in compliance with Fuel EU, is it more expensive?
Of course, and basically today, when we speak about alternative fuels, we speak about biofuels, because we don't have any other type of fuels available, or at least in a substantial quantity. The Fuel EU is made so it will encourage gradually through stricter implementation and stricter penalties to make the use of fossil fuels more expensive compared to alternative fuels, so the people will start using alternative fuels. So this will be a kind of a market mechanism to push alternative fuels.
You have been focusing on biofuels, am I right?
We have used biofuels until now, yes.
And
in several occasions, yes.
in your Newbuilds, I think 2 of them are going to be dual fuel with biofuels.
No, I mean, okay, I mean, this is another story. We have 2 orders of dual methanol ships.
Methanol, right.
So this is not a biofuel. So the methanol ships will come 2026, 2027. They basically target the next, the IMO regulation, not the EU regulation. The EU regulation, I think we can handle it through the limited use of biofuels. The other regulation, I think, will be, because it has a global impact, so it penalizes the global trade, not only the trade from and to European Union. It will have a greater impact, and that's why we have these 2 dual methanol ships.
So now let's move to the market conditions, the market outlook. In your Q3 presentation, you refer to a potentially tight supply and demand balance, with fleet supply slightly potentially exceeding demand over the 2025-2026 period. What do you expect on the demand and supply side, and any particular catalysts? And maybe let's start focusing on the demand side. China's growth seems to be slowing down while India's growth is picking up. How do you see the demand situation developing?
Yes, the weakening of the market right now has to do with several global uncertainties about where the global trade will be leading towards next year. Sometimes, okay, China is weaker, India is improving, but I think that overall, because the supply of new build vessels is limited for the following years. I mean, if you go now out in the market and try to order a vessel, this will be delivered towards 2027 or 2028. So there is no substantial risk from the supply side. The demand will play the crucial role, and what we want to see is global improvement of GDP. So if you have global improvement of GDP, this means additional or more intense needs of transportation of bulk commodities, and this will help our market. If there are restrictions globally, this could lead to reduction of, or let's say to stabilization of transportation of global commodities, which will impose, let's say, certain restrictions in the trading in the global trade.
So moving on to the supply side, here we have new building deliveries, scrapping, and also the impact of slowdown to meet environmental regulations. How do you see all these factors evolving?
Could you please repeat the question, the last part? Because
yes, on the supply side, we have
yes.
a number of factors interacting. Like we have the new building deliveries, we have the scrapping, the aging of the fleet, and also the impact of slowdown on fleet supply, and especially given the environmental regulations, slowdown may be occurring throughout the global fleet. So how do you see all these factors playing in the fleet supply side?
Yes, generally the fleet has slowed down, so we don't have, let's say, the speeds that we used to have far in the past. I mean, 14 knots. I mean, generally we go with 11 or 12 knots, and we cannot go slower than that because of the limitation of the main engines. I believe that as we move along, the environmental regulation will be playing an additional role because right now, as we all know, the vessels will be classified into 5 categories or 5 classes: A, B, C, D, E. And generally speaking, although there are no any penalties from IMO in relation to what they will do with an E-vessel, we all know that the tradability of an E-vessel will not be the same as the tradability of A vessels. We feel that, and we don't have basically E vessels. So I think that in 2025, 2026, as we move along, the people who have the companies that have E vessels will need to scrap them, or they will. And the 2-tier market will be developed. The one for, let's say, from the heavy vessels, heavy consuming vessels, and the other for the, let's say, more advanced vessels. And this will be clearly benefiting the companies like ours that we have done our homework back in the past from 2020 to 2022. We have made several orders. We have improved our energy efficiency. We are renewing our fleet, and so I think that we will have with the same vessels additional operating revenues.
Thank you. Now, Loukas, one last question on the topic. We have a new administration coming in the US. There's a lot of discussion about their potential trade policies. Any opinion or in terms of how these potential policies might impact the market?
I don't believe that change of administration plays a significant role. It always it creates a climate of transition quite often. But after, let's say, the change and the transition to the new administration, I think things will normalize. And because everybody, I mean, old or new administration, what administrations globally want is improvement of GDP for the welfare of their people. So what we want to see is we want to see the global GDP improving. And this is the key for our industry in order to be able to transport more goods, more dry bulk commodities worldwide. Always, I would say, things that play a negative role are tariffs and let's say measures that restrict the trade, and the open market where we operate gets benefits when there is a free market without tariffs.
Thank you. Now let's move to the last part of our discussion. Let's move on the share repurchase program and capital allocation. So Safe Bulkers announced recently after your earnings a 5 million share stock repurchase program. What drove this decision, and how does it align with your broader capital allocation strategy? Specifically, how do you balance returning value to shareholders through dividends and buybacks while continuing to invest in fleet upgrades and new builds?
Yes, this is a very good question. I mean, it's not the first time that we have done a buyback. We have done, I think, a few times buyback in the past, and this is one more time that we are doing that. We have positive cash flows from operations, and we need to allocate them. So basically, what we do is we direct a portion to our new builds. So we take delivery of new builds without any additional loans in terms of leverage. So we try to maintain the leverage where it is. The second point is that as we move along, what we have to do is we're considering what to do with the money, and we want to find reasonable investments. If you go and buy a vessel right now, a new build, because you wouldn't go to buy a second-hand, basically you would prefer to go and buy a new build with 30% reduced energy efficiency. So if you go and buy a new build, this will be delivered to you after 3 years from now. And the interest rates are also quite high. Still, they're quite high. So the cost of a new build is substantial. And what we believe, because the market believes differently, and our stock market is what it is, we believe that because we are a shipping company and we're not traders of our stock, we believe that there is substantial room ahead of the stock price. So instead of buying a ship, we prefer to buy a stock which is, I don't know, substantially lower compared to the valuation of the company, the net asset value of the stock, as described by the market. And we prefer to buy it and invest in our company. And also, this is an additional proof that we believe in what we are doing. It's a comfortable position for our shareholders that they feel that we're investing in our company by buying the stock. And so I think that at the end of the day, we have two strategies right now. We try to pay a dividend, which is 5 cents per quarter. This is something that we have done all the past quarters. And we have done also a few buyback programs, which also benefit our shareholders and represent our view of how our stock should trade.
Lucas, to sum up what you said, you direct the bulk of your cash flow, let's say, to the investments that you have in your new builds and fleet upgrades, while at the same time you have been paying a 5-cent dividend, and you do the buyback in terms of shareholder returns. So now we have come to the end of our discussion. I'd like to thank you very much for being with us. Maybe a last question is, do you view the share repurchase as a signal that you're undervalued in the market?
We believe that it is a signal that we feel that our stock is undervalued. Of course, the price of the market of our stock is reflected in the price at the stock exchange, and so we have to live with that. But we think that by investing in our stock, it's a good opportunity, and we can also take the benefit as a company.
Well, I'd like to thank you. We had with us Dr. Loukas Barmparis. He is the president of NYSE listed Safe Bulkers. So we discussed the company's developments, strategy, and the dry bulk sector outlook. Loukas, thank you for being with us today.
Thank you, Nicolas.